couple years ago, when everybody was locked indoors, Zoom became one of the hottest companies around. Businesses and meetings were the norm on Zoom, with almost all business communication being limited to computer screens. Many think Zoom's success during the pandemic was instant, but they were far from an overnight success. The company was founded in 2011 by Eric Yuan. His entrepreneurial determination became pretty clear as he persisted through 9 visa applications before finally being able to call Silicon Valley his new home. Nowadays, the company must feel like they are under siege from every angle imaginable. Zoom understands how hard it is to convert a free user into a paid subscription. After all, there are many alternatives that do not limit the amount of time a meeting can be hosted. Alternatives such as Discord cater to different demographics and users, although many businesses have begun shifting operations to the platform in an effort to reduce costs during economic hardships and times of slowdown. When Jerome raises rates, it doesn't give as much wiggle room for companies to spend on products such as Zoom. Needless to say, it is an immensely competitive industry, although Zoom carved out a significant user base, especially for business use. The chart isn't the cleanest or the hottest. We can still see that around the $75 zone we have heavy supply, trading off the supply since early 2023. Over 75, the expectation that the $90 supply zone would get retested isn't too unreasonable at all. What's a little bit more interesting, though, are the financials and certain discussions with management that are likely to hinder the performance of Zoom stock. Alright, we got another deep dive. Let's go. A quick income statement analysis shows spending for sales and marketing is up 50% year over year. They are spending a lot of money to acquire new customers. Another risk they cite is their growth associated with their marketing capabilities. They say that if they are unable to hire qualified sales personnel soon, that could really affect their growth in the future. This makes sense, as their increase in marketing expense shows us really how much they're trying to generate stable revenue through acquiring more customers. Just because revenues grew or exploded in a previous year or quarter doesn't mean that it will happen the same way in future periods. Zoom understands that certain changes to their business could lead to a decline in revenues. They cite factors such as market penetration, increased competition, inflation, and a slowing demand for their platform since the recovery from the pandemic. This also makes sense, as more people are returning to work and school, which would create the platform a novelty rather than a necessity for those people. Lastly, operating in a competitive industry can be a great opportunity as well as a really big risk. Zoom knows the danger bundled solutions such as Microsoft Teams and the Google Suite pose to its business. As more players come into the game, it will be harder to attract more customers despite newer technologies. The real trouble comes with the pricing strategy of Zoom. They cite that in the future, their competitors may offer free or lower priced products that directly affect Zoom's bottom line, which is already happening. A couple years ago, Zoom stock was high off capitalist fumes, but now it faces major risks and has a lot less net income.